Hello, this is Arthur Hill with On Trend, the show designed to keep you on the right side of the trend. Today we're going to start with small caps leading the pullback. We'll look at some high-flying stocks that are taking a breather, but some of the big heavyweights in QQQ are coming to life. Healthcare providers are weighing. Banks are getting a Bollinger Band contraction, and we'll finish with stocks to watch. Small caps led the pullback that we've seen over the last few days, and to illustrate that, I'm showing a chart list here that has 6 major index ETFs. It's titled Candle Glance Major Index ETFs, and there you can see the 6 major index ETFs. And once you have a chart list that is focused on a particular group of ETFs or stocks, it's easy to make comparisons and see the leaders and the laggards. And so what I've got here up at the top, you have the View List As drop-down menu. And if I click on that menu, I've got a number of different options to view all these charts in my chart list. And I'm going to choose Summary, and that's going to give me the percentage change for one day. It says intraday, but that's basically for yesterday because it's still, the market hasn't opened yet today. So you can see there is the period setting. And then on the right, you've got the percentage change, and you've got these bars showing you the degree of gain or loss. And you can see QQQ was the only one with a gain yesterday. And as far as the losing ETFs, IWM, the Russell 2000, and IJR, the S&P Small Cap 600 ETF, were down. Now, what's great about this is I can go to 1 week. I could even go to year to date. If I go to 1 week, I can see also that the S&P Small Cap 600 is the biggest loser, and the second biggest loser is the Russell 2000 ETF. So again, small caps are lagging, but look who's leading, QQQ. So that's some interesting information there, that QQQ is holding up relatively well over the past day and week. Now, if I go to year to date, we can see that everything is up and up quite strong. The biggest gainer is the Russell 2000, up 17%. And then the second biggest gainer would be mid caps, up 15.4%. So these are huge gains. And, you know, it's entirely normal to have a stalling period where you digest these gains. Now, we can also see weakness in small caps appearing when we look at the percentage of stocks above the 20-day EMA. And I've been following this indicator for quite a while because you can see here I've got it for the S&P 500, the S&P Mid Cap 400, the S&P Small Cap 600, and down at the bottom, the NASDAQ. And you can see that the NASDAQ remains above 70%, NASDAQ 100 that is. The S&P 500 remains above 70%. So these two are holding up just fine. Mid caps finished at 70%. So they're on the verge of moving below that threshold that could signal the start of a pullback. And then you see small caps move below 70% last week and to the lowest level since actually that big surge in early January. So we're seeing the fewest number of small cap stocks above their 20-day EMAs. And that tells you that small caps are leading this pullback that we're seeing over the last few days. So let's look at some candlestick charts for the major index ETFs. The first up here is SPY, and we can see that we had that big surge in January. We had a little pennant, a pennant breakout, and we've just continued higher. And now we've stalled out a little bit over the last, say, 5-6 days here around that 280 area. So we opened strong yesterday. We moved down below 277.5, but closed above 279. So, you know, they're still holding up here above this support zone, and that's the first level to watch. If we break yesterday's low, then that would suggest that a pullback is starting, and we could expect some sort of retracement of that big 20% advance that we saw from late December to early March. Now, if we go down the list, we look at QQQ. Now, it's important to remember that the default is the trend is up. All right, we have yet to change that default trend, if you will. The trend in force right now is still up, and it's up to the bears to prove that uptrend otherwise. And if you look at SPY and QQQ, there's nothing yet to prove that otherwise. You know, QQQ as well had the pennant breakout, and it's just been working its way higher, but it continues to hold support, and I'm going to mark it at 170 with a little buffer. And if you break below that level, then we have reversed that short-term uptrend, and maybe then we get a retracement of the prior advance. We look at IWM, and it looks a little bit different because you can see IWM has pulled back over the last 5-6 days here with a slight decline. And maybe it's a falling flag. And if it is, then a breakout there would be bullish for that flag and signal a continuation higher. And you can see along the way here, we've had short pullbacks. And so this is still just a short pullback within a bigger uptrend. And I would not throw in the towel until you see SPY and QQQ start breaking support. And then MDY, a similar pattern setting up here. You can see the pullback over the last 6 days there. Might be a flag there. So if we get a breakout there, that's going to be bullish. So I also noticed that a lot of high-flying stocks took a breather yesterday and pulled back rather sharply over the last 1 to 2 days. And these were stocks that were leading this year with some double-digit gains in most of them, and most of them had hit 52-week highs in late February and early March. So they were the clear leaders, and this tells me we're getting some profit-taking here in these leaders, and it's perfectly normal. You know, it's the ebb and flow of the stock market. So what I did was I singled out 11 stocks here, and you'll recognize these names: Tableau Software, Workday, Salesforce.com, which reported earnings yesterday, Splunk, ServiceNow, Twilio, Alarm, Atlassian, CyberArk Software, PayPal, and Veeva Systems. These are the momentum leaders, or they were the momentum leaders in late February and early March. And look how they were slammed yesterday, down between 2.26% and 6%. So this is just a one-day perf chart. And if I right-click on that perf chart and I go year to date, you can see everything changes. They're all up double digits. The smallest gain is Alarm, up 10%, Workday up 12%, and then Tableau Software is up just 4%. You know, but look at these other gains. Some of them are up really big. CyberArk's up 40%. Veeva is up 29.2%. So this is just a pullback after a big advance so far. And you have to ask yourself, when you're in these stocks, do I want to sit through a pullback? And because I think it's okay to take profits at some point and look for another opportunity later on, or another stock that maybe has a better entry. I really don't think there's anything wrong with taking profits. So what I've done is I've highlighted all of these names, and I'm going to paste them into the window at the top there for the sharp chart, but I'm going to change it to candle glance. And if you click go, then you can see all these in candle glance format. And there you can see these new highs that they were hitting. For some reason, I've got unable to find that symbol, but I'll refresh and I think it'll be back. There we go. So here we have at the top, you can see some of these leaders. 52-week high at 135 there for data, Tableau. Workday, a 52-week high. CRM, I believe that's a 52-week high. Splunk, ServiceNow, Twilio. And then if we scroll down a little bit, we can see Alarm hitting a new high and then getting hit really hard. Atlassian, CyberArk, PayPal, and Veeva. Veeva peaked out in late February. So these stocks could pull back, you know, just to give you a rough estimate of where you might expect support, maybe at broken resistance. So there for Veeva could pull back to that 100, 110 area. And you look at PayPal, there's a lot of consolidation here in the low 90s. It could pull back there. CyberArk, I have no idea, maybe back into the gap zone in the low 90s. Alarm is coming into its first support zone already. And then if you go up, you can see one I might be worried about would be Tableau, because it barely hit a new high and is already getting hit pretty hard. Workday could correct back to 170. There you can see Salesforce.com to that 150, 145 area. So that's kind of a way to guesstimate where a stock might pull back, and you have to figure out if you want to hold through that pullback. So what I was also noticing is some of the big techs like Google and Apple held up pretty well. And so here's a selection of some big technology stocks and Disney as well. And from Sharp Chart, I'm going to change this to Perf Chart, and then I'm going to click Go. And I will select that Perf Chart to 2 days, which really means 1 day on the Sharp Chart, or the 1 day percentage change. So you see all those high flyers were hit, but look at these stocks that were up yesterday. Facebook was up 3%. Intel was up 1.2%. And then we had smaller gains in the other ones, but they performed very well yesterday. And keep in mind, Apple, Alphabet, Intel, Facebook, and we'll throw in Amazon a little bit later, and Microsoft, they account for the lion's share of QQQ, and if they're strong, that bodes well for QQQ. If we go to year to date, we can see the changes. Disney is up the least, but I still think it has a constructive chart. So another way we can compare momentum with, say, low volatility is by using ETFs. And here's the momentum factor ETF relative to the minimum volatility ETF. And actually the price relative is down below, where you can see I've got the momentum ETF divided by the minimum volatility ETF. So that, of course, is the price relative. And you can see that momentum outperformed minimum volatility up until June and started underperforming here and really underperformed October to December. And even though we've had this big surge in the market, the momentum stocks are still not outperforming. As you can see, they remain below this kind of, it's not really a resistance level but if you do break above it, that would signal an upturn and a signal that momentum was outperforming. And the reason I don't say it's a resistance level is because it's not based on actual supply. There's not people trading that 195 level. At least I don't think there are. Some people might argue with me differently, but the point is, if you break above it, that would signal outperformance from momentum, and I think that would be positive for the market. Not that outperformance by minimum volatility is negative, because you can see the market can rally as long as enough stocks rally. It doesn't matter which ones. As long as 50 plus 1% are moving higher, that's enough to carry the broader market. If you look at the minimum volatility ETF, you can see that it hit new highs, whereas the momentum ETF remains well below its highs. Now, the next group comes from Power Shares, and it is the momentum ETF relative to the low volatility ETF. And again, the price relative is in the lower window there. But we can see here that the low volatility ETF hit a new high there in mid-February, whereas the momentum ETF remains well below its high, so clearly outperforming there. And there you can see that you look at momentum relative to low volatility, momentum is still stuck in a rut. It can't outperform low volatility, and so we need to get a breakout here to signal that momentum is outperforming low volatility. So before I look at some top QQQ stocks, I just want to show you where I found this information. I'm here on the Invesco website, which is the fund family for Power Shares. And there you can see the sector allocation for QQQ. And if I click the portfolio link, I will be taken down and I can see the top holdings for QQQ. And there you can see that Microsoft, Apple, Amazon, and we have to add Google because it's listed twice there, at the top. But all three of these account for, well, the first three account for like 9+%. Alphabet accounts for around 8.7%, and Facebook at 4.7%. So if you do just a back of the envelope calculation, you can see that these ones account for almost 50% of the ETF. So you need to watch these 5 if you're interested in the direction of QQQ. So first up, we have Apple, and I pointed these stocks out, 3 of them, Apple, Amazon, and Alphabet, last Wednesday in Art's charts. And the pattern at work was a bullish continuation pattern. You know, the problem is it's below the 200-day moving average, but, you know, this advance here since January remains in play. It had a breakout there, and then a consolidation, and we have another breakout working. So, you know, if you go below last week's low, then that breakout is starting to fail. And if you close below 170, then you have a reversal of the short-term uptrend, and that would be negative. But right now, there's an active bullish breakout for Apple, and that bodes well for QQQ. Then if we look at Amazon, all right, Amazon, I called this noise here. It was just kind of like a fielder's choice. You know, you had that surge and that gap. And I think the essence of the pattern here is basically you have a surge and a pullback. And it was like a flag-like pullback. And look at that, we're breaking out now. So it looks like Amazon is starting to pick up some steam again. And that bodes well for QQQ. Then we look at Facebook. Facebook came alive yesterday when the market was under pressure. So Facebook, of course, had that big gap up and then pulled back. It got a breakout, but fell back, and now it is broken above that previous high and the 200-day. So as long as Facebook holds that gap there, I think this is a valid breakout, and that would help the communications sector because Facebook's one of the bigger stocks in that sector. Then if we look at Alphabet, which was featured in Don't Ignore This Chart yesterday and last Wednesday in Art's charts, ton of support at the 1,000 area. You hit it 1, 2, 3, 4, 5, 6, 7 times. And each time you manage to get a bounce. And this is the strongest bounce since December. Of course, that one tested again, but you've broken above this high here. And even though you fell back after the breakout, I wouldn't really call it a failed breakout because you're up like 15% from 980 to 1150. So you're entitled to a pullback or consolidation or a rest. So we did eke out a higher high, and now we consolidated. And in that consolidation signaled an end with the breakout that we got on Friday. So you can mark support there at 1100, and I would be bullish on Google as long as 1100 holds. So that's net positive for QQQ. And then the next one is Microsoft. And this was highlighted a couple weeks ago in Don't Ignore This Chart. And Microsoft had the surge, sloppy consolidation, but then a breakout. So it is showing some serious leadership here. Could it pull back to that breakout zone? It certainly could. But right now, I think this is more bullish than bearish. So the healthcare sector was one of the weakest sectors yesterday, down around 1.36%. But we look under the hood, we can see that one industry group was primarily responsible for that. That would be healthcare providers here. And if you look at this chart here, you say, well, is this a nice steady uptrend? Well, no, it's not. You know, maybe it's an uptrend. You could put a 200-day on there. But I mean, you know, for real, look at this chart here. You had this big swoop down in October, a test of the high. So maybe you had a double top. And then you broke down here. So, oh man, we're going down below the April lows. Oh no, we rallied back. And now we're back below this double top. So, you know, I think it's just one big mess. And I see a chart like this and I just say next. I'm looking for much more stability in my charts and much more stability in that uptrend. All right, I want to see higher lows and higher highs. And so this is not a higher high, and this is not a higher low. It's a lower low. So, you've got a choice out there. And if you see this chart, it doesn't matter what it is. If it's a sector ETF, an industry group ETF, a major index ETF, or an individual stock, a chart is a chart is a chart is a chart. And you look at that chart and you say, is this something I want to be involved in? And I look at it and I say, no, it's something I'm going to just not even look at. I'm looking for a more stable uptrend. So let's look within the sector at some of the groups that are weighing on it. So let's look at some industry group ETFs within the healthcare sector. And the first up is the Biotech iShares. And you notice that this biotech ETF is weighted by market cap. So the big biotechs carry the most weight: Celgene, Biogen, Gilead, Amgen, Illumina, and Regeneron. And if you look at this price action here, we had a big surge and then a consolidation and a breakout. And there's a little gap there. And I would suggest that as long as 110 holds there, that this is a bullish pattern right here. If we close below 110, then the breakout has failed. But IBB was only down 1% yesterday, so it held up better than the sector, as you can see. If we look at the broader based XBI biotech ETF, you can see the holdings on the left, and they're all fairly equally weighted. You can see Celgene is only 1.6%, and Luxo is above Celgene. But this one's a little bit stronger because we had this, pennant formation forming there into January, and then the breakout, and we've continued higher. And look at that gap. So as long as that gap holds, say, unless we close below 85, I think the trend is up here for XBI. Now, if you're playing this pennant breakout here, because it's a short-term pattern, I assume you'd be more of a short-term player because you get a surge, you get a pennant, and you get a breakout. That's a continuation of this prior surge. There's nothing wrong with taking profits in the 90s or taking some money off of the table, unless you want to ride a pullback maybe to 85 and put a stop loss there. But again, I see nothing wrong with taking some profits and looking for another opportunity. Now here's the culprit, IHF, the Healthcare Providers ETF. You can see that it had the breakdown there in December, had a big bounce, but is now broken down again over the last 5 days with that decline below support, back below the 200-day and back below the 50-day. So this is the reason healthcare is down so much. And then we look at medical devices. You would think, okay, medical devices, good defensive sector. We're always going to need medical devices and equipment. But then you get a 20% drop. And then you get a 26% advance all within a 6-month period. So again, it's just, once this happened to the chart, it kind of threw me out because it wasn't a steady uptrend. And so I had to look elsewhere for stronger chart patterns out there. But it's at a 52-week high. It was down 1% yesterday, weighing on healthcare, but not as much as healthcare providers. Now, there's one group of stocks that has gone nowhere for the past over a month now. If you look here at Bank of America here, you can see that, it moved above 29 there in the latter part of January, and it's currently at 29. It's had a dip and a bounce in between then, and I think that, was a little wedge, and then we got the wedge breakout. So I think that's the dominant pattern right now. But the shaded area shows basically a consolidation. And if you look at the Bollinger Band width indicator down below, you can see that it's been flatlining at a low level, lowest level we've seen since September there. So we had a tightening of the consolidation, and then we had the breakdown. So here we've already got a breakout and we've got a tightening of the consolidation. I guess you could watch that 200-day. And if you move back below that level, then you got some reason to worry about Bank of America. Well, what's also interesting is a number of these financials are doing this. And I'm just focusing on the banks. I'm not focusing on Berkshire because that's kind of a special situation. But, look at the Bollinger Band width for Citigroup. Very low, back to its September levels there as it consolidates. And you still got the pennant breakout, but it's coming under threat here. So I would suggest if you go below 62, you have to reevaluate that breakout. And then you look at Goldman Sachs, again, on a road to nowhere. Love that song from Talking Heads. But you can see the Bollinger Band width is back at the levels that we saw in the summer and fall there as the stock consolidates. So maybe you can watch 190. If you break 190, then you've got some trouble here for Goldman. And then we look at JP Morgan. I still think the dominant pattern is the breakout right there. All right, we've fallen back a little bit after the breakout, but it's holding more or less. So there's a gap right there that's kind of holding. So if you go below 102, then that breakout has failed. All right, so a few stocks to watch here. Tesla is breaking down and it's really underperformed. It was an outperformer from October until early December. And then for all of this year, it's been underperforming. And you can see it's never recovered from this gap down because it just consolidated after the gap and then it broke below that consolidation line there yesterday. So it looks like Tesla is going to test the October lows, if not head even lower. Now I'm seeing some perking up in two materials stocks that were some serious laggards in 2018. The first is Martin Marietta, and you can see it's got a resistance level there around 200, 195, 200. But we did get a higher low in December. RSI didn't break below 30, and we've just been working our way higher. And most recently, we had this kind of like flag pattern and a breakout. This is more of an observation. I don't think it's a play here just yet, but it's an observation. And here's Vulcan Materials. It's showing some relative strength all of a sudden by breaking above that high there. So if we look at this pattern at work here, maybe there's some sort of a big triangle that it broke out of here. And then now we have a small flag that it is breaking out of. So this is an interesting development here for these two big materials players. Next up is Disney, and I still think Disney looks productive or positive here because it kind of got a breakout there out of this consolidation, and that zone is holding. So maybe you reevaluate on a close below 112. Iron Mountain. Now this one I believe is a REIT. They're in the data storage business. But look at this, breaking out of a big consolidation. You get the throwback after the breakout, and maybe it's, a little flag or a wedge type pattern. And if you get another breakout there, then that is going to be bullish. And two speculative names for you to watch here. Planet Fitness. You can see this consolidation. It turned quite volatile. Look at that last week, that move above 60 and below 58. But now it's getting a breakout to new highs. As a lot of people have signed up for Planet Fitness after the new year. And GLUU Mobile, which is a Chinese play, I believe. You can see a potential wedge developing here above the breakout zone as you get a throwback. So watch for a breakout there. It's low price, so that means high risk. And that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.